Hey guys, what's up? Alec back with the daily stock market, and I just wanted to do a quick video update. I want to do a quick deep dive on DraftKings versus PENN, ticker symbol PENN. It's football season. We have sports heating up. This is going to be a great investment video for you to get some advice and just some ideas and get your brain turning on PENN versus DraftKings, which one's better overall and which one I'm investing in, or if I'm investing in both. Okay, so first up, we have DraftKings, okay? And they're down 11% in the past week. That's why we're talking about them too, is because they're pretty much a good pickup for long term as of right now. So in the past year, they're down 4%. So they're pretty close to a 52-week low. All right, in the last 5 years, obviously they IPO'd at around $10 per share, and they've just been going up from there. Now the question is, are they better than their competitor PENN? Should you buy them? I have 10 shares. $500, we're up around 15%. If we scroll down and look at what they have going on, they have a $40 billion market cap. Remember that market cap because that's going to be important to compare against PENN to see which one's the bigger company. The 52-week low, 52-week high is almost double of the 52-week low, the 52-week high is. And you can also see that it has a volume of around 10 million and an average volume of around 15 million. So it's a very actively traded stock. We'll also see that Cathie Wood piles another $40 million in shares in DraftKings. Admin talks of a $22 billion Etain acquisition. All right. These are other key trades from Wednesday that Cathie Woods did. So if we go in and look a little bit more, you can pause this, read a little bit, see what's going on. DraftKings this week confirmed it's seeking to acquire European rival Etain PLC for about $22 billion. Wow, so that's absolutely huge acquisition that could be on the miss of DraftKings. Remember, DraftKings is a $40 billion market cap as their company, and they're trying to acquire a $22 billion company. So that can be a huge make it or break it for DraftKings. But the European market is huge, so that can be a great idea coming from DraftKings to take over the European market and get an edge that PENN does not have. Now, if we look at PENN, they're sitting at $75 per share. They're not down like DraftKings is. They're actually up 20% in the past year, and they've even been as high as $130 before, which is almost double the price of what they're sitting at right now. They've also been around a lot longer than DraftKings. You know, they IPO'd a long time ago, and they've been going from $13 per share all the way to $130 per share, which is a 10x. I have almost the same amount of market value in PENN as DraftKings. We're only up 2%. And you can see the market cap is where things start to get interesting, okay? They're only $11 billion market cap, so they're about 1/4 of the size of DraftKings, and DraftKings is acquiring another company, or they're trying to acquire another company that's twice the size of PENN as well. We can also see PENN's a profitable company because they have a PE ratio of 28, which is pretty attractive in the market we're sitting in. And we see the volume is a lot lower than DraftKings, so it's not nearly as heavily traded as something like DraftKings. PENN isn't. Okay, now if we go to the 52-week low, 52-week high, we can also see that it's more volatile of a stock because we see it almost triple. The 52-week high is almost triple of the 52-week low. They've been beating their earnings consistently, Q1, Q2, and Q3. They're coming in profitable at about $1.28 in EPS. So if we look what's going on with DraftKings, you know, they're a lot bigger company, but let's check out their income and their total revenue, see what's going on. Now, what we see is their total net income was negative $800 million, almost negative $1 billion on their net income. Their total revenue, however, is looking good, $61 million. But the scary thing is that their net income is negative $800 million, which is more than their total revenue. They're losing more money than they're even getting on their total revenue. But if we look at what these are currently up to date, Q2 2021, we have total revenue up 300%, up to just $300 million in 1 quarter. Right? Which means they could be on track for $1.2 billion in revenue this year if they keep up what's going on. Now, if we scroll down, we can see their profits. Their gross profits are up almost 400% year over year. However, we see their net income is still negative $300 million just for 1 quarter which is very scary to think about. All right. So they're not profitable by any means, but they're growing their revenue, which is a good sign. Now, if we go down to their balance sheet, this is where things get a little bit more comfortable because we can see that they have $3.4 billion in assets and only $800 million in liabilities, which means that they're paying off a lot of their debts. They don't owe a lot of money, and they have a lot of assets. Now, their cash and cash equivalents is up 115%, which is great to see. Total current assets is up 100% to $3 billion. So that's good to see as well. But let's scroll down and see if their total liabilities have grown. So now we can see if we go to total assets, we see that it's now at $4.3 billion. It's grown. But let's make sure that that liabilities really hasn't grown as well. And it has. Total liabilities has actually grown 500%, which is alarming, right? They're taking on a lot more debts. And you can actually see other non-current liabilities has grown 283%. Total current liabilities have grown 2,000% to $1.5 billion. So their total liabilities are now $2.1 billion. We'll say $2 billion to make it easy, and the assets are $4 billion. So their balance sheet still isn't horrible, but it's closer to 50% assets to liabilities. $4 billion in assets, $2 billion in liabilities, which isn't the worst thing in the world. Let's look at PENN and see if they're a little bit more attractive. All right, so now we have PENN pulled up. In 2017, they were very profitable. You can actually see they had a 500% increase to $730 million in net income. But now it looks like they're pretty much negative if you go into 2020. So we'll look at the most recent quarter in a second, but let's look at total revenue first. So here you can actually see their total revenue is higher than DraftKings. So when we go over to total revenue, that's when it starts to get interesting because remember, PENN is a fourth of the size, 1/4 the size of DraftKings, but they're doing 3 times as much revenue as DraftKings. All right, so PENN is killing the revenue. They're not growing crazy. They were going crazy in like 2018, 2019, but they've actually stepped back and now they're at a 32% loss, only $3.5 billion in total revenue, which is significantly higher than DraftKings. If you rewind the video a little bit, you can see that their total revenue for the year was like $600 million. Let's see these up-to-date numbers, all right? So just in one quarter, PENN has now done $1.5 billion in total revenue. Holy cow. So they're on track for about $6 billion in total revenue, which is absolutely amazing to see. Their net income was positive for the last quarter. You can see it was $198 million. And before that, the quarter before that was $90 million. So on top of being a profitable company, they're absolutely destroying DraftKings on revenue and net income. So it's not even comparable. Their income statement is an A+, while DraftKings is in the D+ category for an income statement. So significantly better. And the value of you're getting at PENN is 1/4 of the market cap too. Now, a lot of things are probably priced in for DraftKings, like the acquisition of this new European company, for example. That could be huge if we look at their total revenue and see how much that company is doing that they're going to be acquiring and the net income and everything too. That might be interesting to look at. Now, if we're still on PENN, we're looking at the balance sheet. PENN's balance sheet is not as good as DraftKings' balance sheet is. All right, DraftKings has significantly lower assets and significantly lower liabilities, but the ratio is with PENN that we're looking at, the total liabilities almost line up directly with the assets. Where if you remember, DraftKings' liabilities and assets, they were pretty far off. They were like 50% more assets than liabilities, where in this example, there's only 20% more assets than liabilities for PENN. So PENN's balance sheet's closer to a D, maybe a D+, while DraftKings' balance sheet's closer to like a B or a B+. And if you guys want to know where I look at these balance sheets and income statements, it's all on WeBull. It's a very user-friendly website and app. And if you're in the United States, I definitely recommend getting them. And I'm also going to be doing a giveaway to any new signups, $10 extra. So if you sign up and you don't have a WeBull account, it's an amazing account for one, but you also get 2 free stocks from WeBull from signing up. And then I'm also going to Cash App you or Venmo you 10 extra dollars on the top of the 2 free stocks. I'm only going to be doing the giveaway a little bit longer. So if you guys want WeBull and you've been wanting to get it for a while, it's honestly better than Robinhood or any other trading platform in my opinion. You can do fractional shares, price alerts, you can look at charts, options, and it's very technical too. So you can set like moving averages. You see that little red line there, and you can actually see when the earnings, so these blue dots here are all when they do earnings, report earnings, and you can see how it's affected against earnings. So typically you see PENN, when they release earnings, the stock goes up a little bit, but here you'll actually see they released earnings, they went down. All right, so it's awesome platform for trading, especially if you're a technical trader. This is definitely the platform for you. You can even put your RSI at the bottom and your MACD. Even if you're a more fundamental trader, the company's financials, balance sheets, and everything's very awesome to look at here too. It's a glance of an eye. You can see Q2, 1.5 billion, up 400% year over year. And then their net income is to the right of that. So you want to make sure you're setting yourself up with the right tools on, and WeBull definitely has them as well. Just message me on Instagram at the Daily Stock Market, same as the YouTube, the Daily Stock Market on Instagram, and I'll send you over a link to sign up using my link and give you that 10 extra dollars as well. Now, if we look at what these analysts are saying, they actually have on average a 41% upside for DraftKings over the next 12 months. So remember, these predictions over the next 12 months, we have one analyst saying it's going to be $51 per share, but on average, most of them agree that it's going to be around $72 per share, which is a 41% upside over the next 12 months. We have some analysts even saying up to $100 per share, which can be as much as an 80 to 100% growth. Now, you can actually see where these analysts are coming from and how long ago they reiterated these statements. So a $73 in the next 12 months reiterated 4 days ago, $105 6 days ago reiterated, and these are all 4- and 5-star analysts, keep in mind, that are reiterating these very recently. And that you can see Kathy Wood buying a lot of DraftKings as well. It looks good for this acquisition. That's what a lot of people are looking at right now, this European acquisition. And if they really take that to the next level, the European market, that can be a huge driver long term for DraftKings. So a lot of people aren't really focusing on what the revenue and income is right now for DraftKings. Most people are looking at a year, 2 years, even 5 years down the road when it's a lot more legal. Sports betting and sports gambling's more legalized in the United States, and they also take over that European market. So let's see what the analysts have to say about PENN. And we can see on average, it's a little bit less of an upside, and we have some analysts saying it can be as low as $31 per share. So according to the analysts, there's more risk involved with PENN, and there's less upside, according to these analysts as well. There's only a 27% upside on average. All right, if we see where these analysts are coming from, we can see that $112 from Steven Winowski, and this was reiterated 5 days ago too. So that's a good analyst, a 5-star analyst, and you can even click in to see his success rate. He's 64%, average yearly return 22%. So he's a pretty good guy, all right? Now, some of these other guys are saying 81, 115. We have one guy that's saying sell, Carlo, and he's saying it's 31. Now, this guy is a pretty good analyst too, so you might want to take a little bit of what he's saying, but you don't see any other analysts saying that it's going to be a $31 stock. Majority of these analysts are saying at least above $100 per share. And these are all top-rated analysts that are saying. You even have one from JP Morgan here at $103 per share. All right, so he's had a lot of success in the past. We have a Morgan Stanley analyst here as well that's saying a $91. So in my opinion, PENN is a little bit more risky, yes, but I think it does have a little bit more upside, especially if you get in at a lower price point. If you get in closer to $50 per share or $65 per share, I think that could be beneficial for PENN. But if you're going for DraftKings, I think it is a safer stock overall. And you look at the balance sheet, you can understand that it is a safer stock overall. PENN has a very risky balance sheet. They're growing revenues like crazy. They're having a net income. So they're more of a growth stock, where DraftKings is more of a long-term play. DraftKings is more of a long-term play, and that's what the analysts are seeing. They're seeing the balance sheet. They're seeing how big of a company. It's a well-known brand. Everyone thinks of DraftKings right away. They're one of the leaders in the industry. Kathy Woods is buying them, and now you're even seeing them trying to take over the European market. So it can be very exciting for sports gambling. DraftKings and PENN over the next 6 to 12 months, or even the next 3 to 5 years, with everything becoming more legal in the United States. So if you guys like that analysis, I take time out of my weekend to make these videos for you. Just smash a thumbs up on this video is all I ask for. Let me know what you guys want to see me compare with each other next, what stocks you want me to put against each other. We could even do more risky stocks like ANC versus GameStop. It's a little bit harder to do those though, because there's less fundamentals involved, but we can kind of just see what analysts are saying and everything going on. But I like to do fundamental analysis with these videos. And if you want to learn how to become a more professional investor and more comfortable in the stock market and do an analysis on stocks and fundamentals and learn everything with the stock market, message me, the Daily Stock Market, on Instagram, the same as YouTube. And I have a few more students that I'm taking under my wing for a mentorship program. So if you want to get to the next level, I'm going to be closing signups soon and also raising prices, because as we keep growing and growing, more people want to be a part of it. And unfortunately, not everybody can, because there's only so much that I can do with each person. So if you guys enjoyed that video, hit the like button, hit subscribe. Make sure you share with a friend if you found there's value in this video, and I'll see you in the next video. All right, remember, don't time the market, buy the market. Peace.